A reverse mortgage is a loan for homeowners aged 62 and older. It lets you convert home equity into cash without selling your home or making monthly mortgage payments. The loan, which includes compounded interest, is repaid when the borrower sells the home, moves out permanently, or passes away. The reverse mortgage has evolved significantly since 1961. In 1988, President Reagan authorized the FHA to insure these loans. While the program grew in the 2000s, it lacked some safety measures. Today, the process includes strict financial assessments, mandatory counseling, and enhanced protections for surviving spouses. Reverse mortgages have three core components. First, your home equity acts as collateral, and you retain title as long as you meet the terms. Second, there are no monthly out-of-pocket payments to the lender. Finally, you must maintain your primary residence, pay property taxes, and keep insurance to stay in good standing. Reverse mortgages offer practical, real-world applications. They can provide supplemental retirement income to help cover daily expenses without needing to downsize. Additionally, funds can be used to manage healthcare costs, pay for in-home care, or pay off existing mortgages to eliminate monthly debt. Looking ahead, demand for reverse mortgages is expected to rise as the population ages. We anticipate enhanced protections, lower costs due to increased market competition, and new financial technology designed to streamline the application process for seniors.